it feels like even just a month ago, or certainly just after the last meeting, there was a sense of we'll wait and see to see how the existing fiscal measures, the existing monetary transmission measures are making their way through the economic recovery. So why the need to do more now?
Good morning. Well, we think that while domestically the backdrop has improved, in terms as well of the easing in mobility restrictions in Victoria, what have changed is the global backdrop. So the fact that I think for a long time markets tend to think or tend to believe in a V-shaped recovery in global growth, and now that's becoming a little bit less likely with mobility restriction being imposed again and lockdown being imposed again in Europe. And I think that has played a role in the RBA mindset and in the idea of having to add more to the policy toolkit. And I also think that there's been a change in the RBA communication in the sense that they are keen to do more as the economy reopens and in a way to boost the rebound in the Australian economy going forward.
What about the bond buying side of the equation? That's, I guess, a little bit more of an unknown.
Well, yes, so UBS expect today the RBA to cut the cash rate to 10 basis points and lower the yield curve control target in line with the cash rate, so down to 10 basis points. And we also expect the RBA to lower the cost of the term funding facility. And all of these three policies tend to be connected. They all have the same purpose, which is effectively be sure the short-term rates will remain low. But we also expect the RBA to buy bonds. Effectively, we expect them to buy both ACGBs and semi-government bonds. We don't expect the RBA to give a quantity. We expect them to keep flexibility and just say we're going to buy bonds across the curve in order to lower bond yields. And I think that's also to some extent priced in the market. But I think the RBA forward guidance heading into today's meeting was very strong, and I think they did somehow commit to buy bonds.
Is there a potential, though, that the RBA could surprise the markets, perhaps not with the rate cut, but in the form that QE could take? And remember, this is a pretty volatile week because of the U.S. elections already.
Oh, look, I think you're right. So market is priced for a rate cut, TFF, YCC, and QE. So the risk is that they could disappoint. I don't think that they could disappoint in the sense of not buying bonds. I think that all the language around the fact that the balance sheet in Australia, the RBA balance sheet is below other advanced economy, was a clear hint to the fact that they want to do QE. But I think there could be some disappointment in markets in terms of how that's communicated. So what we don't know is exactly how much QE markets are expecting. So we flagged that the RBA could buy 100 billion of ACGBs and around 20 billion of semi-government bonds. But it's hard to know if that's consensus or if markets are expecting more from the RBA or less. So it's going to be quite a day today. It's going to be quite volatile at the time of the announcement. But, yeah, the risk, it is tilted towards some disappointment given how market is positioned heading into this meeting.
Last time in March, when we had the RBA cutting rates and also announcing that target for the 3-year yields, we saw the Aussie dollar plunging to the lowest level, I think, in years since 2002 or so. What sort of impact could we see in the Aussie dollar with the announcement today?
So if we look at the offshore experience and what academic articles have been finding in terms of the impact on the currency, we know that QE does have an impact on the exchange rate and tends to have a persistent impact on the exchange rate. So you would expect that the currency will move lower. As I said, a lot is priced, so it's hard to say by how much, but he will have an impact over the medium term on the Aussie dollar. And that's exactly what the RBA wants to achieve as well. So the Australian dollar is one of the key transmission mechanisms for monetary policy. And so that's a time where you want your currency to be below your fundamentals because you need to have a tailwind for the economy and to have the rebound.